Hello, lovely people. Welcome to a journey that could change the way you see business forever. Entering the business world can feel like learning a new language. Terms like burn rate and liquidity can be overwhelming, especially when you're just starting out and everyone around you seems to be speaking in code. But here's the truth. Once you learn the basics, it all starts to make sense. The fog lifts, and suddenly, you're able to join the conversation with confidence. Understanding business terms isn't just for sounding smart. It's about knowing if a company is truly healthy and being able to spot opportunities or red flags before anyone else. When I'm in the den, I listen for how entrepreneurs talk about their numbers. The way they explain their figures tells me a lot about their grasp of the business. It shows if they're in control or just guessing. Confidence comes from knowledge, not luck. Your first big investment should be in your own knowledge. Before you put money into any venture, invest time in understanding the basics. It pays off for life. The more you know, the more you grow, and the more confident you'll feel making big decisions. Think of business vocabulary as your toolkit. Terms like revenue, profit, and cash flow help you build and fix your business. Each word is a tool that helps you understand what's really happening behind the scenes. Revenue, profit, cash flow. These aren't just buzzwords. They're the foundation of every successful business. Relying on gut feeling alone is risky. Facts and figures give you real confidence. Numbers tell a story that instincts alone can't reveal. Let's break down the language barrier together, so you can understand and use these building blocks for your own success. Ready? Let's get started on this exciting path to business mastery. Let's start with the basics: revenue and profit. These are the foundation of every business, no matter the size or industry. Revenue is all the money your business brings in from sales before any expenses are taken out. It's the total amount customers pay for your products or services. For example, if you sell 100 greeting cards at $3 each, your revenue is $300. This is your top-line number, showing how much you've earned before costs. But profit is what's left after you pay for everything it takes to run your business, like materials, rent, salaries, and marketing. It's your reward for all the hard work. If your costs add up to $170, your profit is $130. This is the money you actually get to keep, and it's what helps your business grow. Here's the catch. Profit and cash flow aren't the same thing, even though people often mix them up. You can be profitable on paper but still run out of cash if your customers pay late, or you have to wait months to get paid. Cash flow is the real money moving in and out of your business bank account. It's what you use to pay bills, buy supplies, and keep the lights on. Imagine landing a big order, but the client pays in 90 days. You still need cash now to cover your costs, pay your team, and keep things running smoothly. Many businesses fail not because they aren't profitable, but because they run out of cash and can't pay their bills on time. That's why I always say, cash is king. Managing your cash flow is just as important as making a profit. Understand these basics, and you'll avoid the most common pitfalls that trip up new business owners. Let's keep going. To know your business's health, you need 3 key financial statements. The income statement, or P&L, shows your revenue, costs, and profit over time. Did you make or lose money? The balance sheet is a snapshot of what your business owns, assets, and owes, liabilities, at a specific moment. Assets include cash, equipment, and inventory. Liabilities are loans and unpaid bills. Equity is what's left for owners after debts are paid. The balance sheet must always balance assets, liabilities, plus equity. The cash flow statement tracks real money moving in and out, split into operating, investing, and financing activities. It explains why your bank balance might not match your profit. Master these 3 reports, and you'll truly understand your business's story. Let's move on to the numbers that drive decisions. Once you know your reports, focus on key metrics. Your break-even point is when revenue equals total costs, no profit, no loss. Fixed costs, like rent, stay the same. Variable costs, like materials, change with sales. Margin shows profit as a percentage of revenue, a quick way to compare products. ROI, return on investment, tells you how much profit you make from every pound invested. For startups, burn rate is how fast you spend cash. Runway is how long you can last before running out. If you burn $10,000 a month with $100,000 in the bank, your runway is 10 months. Valuation is what your business is worth, crucial for fundraising and investment. It's based on assets, revenue, growth, and market comparisons. During fundraising, valuation determines how much ownership you give up for investment. Know these numbers, and you'll make smarter decisions. Let's talk about funding. Every business needs funding, either debt or equity. Understanding the difference between these two is crucial for any entrepreneur or business owner, as it shapes how your company will grow and who will have a say in its future. Debt means borrowing money you must repay, like a bank loan. This is a common route for many businesses, especially when they want to maintain full control. You keep ownership, but must make regular payments with interest, which can impact your cash flow and financial flexibility. Equity means selling a share of your business to investors. In exchange for their money, they become partial owners. You don't repay, but you give up some control. Investors may want a say in major decisions or a seat on your board. Shares represent ownership. The more shares someone holds, the more control and influence they have over the company's direction. Profitable companies may pay dividends to shareholders, rewarding them for their investment. However, startups often reinvest profits to fuel faster growth and innovation. Early funding might come from angel investors, wealthy individuals who offer not just cash, but also valuable advice, mentorship, and industry connections. Venture capital, VC firms, invest larger sums and often get involved in business decisions, helping to scale your company rapidly, but expecting significant returns. Bootstrapping means funding the business yourself, using personal savings or revenue. Growth may be slower, but you keep full ownership and independence. An IPO, initial public offering, is when a company sells shares to the public, raising big money, but facing more scrutiny, regulations, and public accountability. Each funding path has trade-offs. Consider your long-term vision, risk tolerance, and what you're willing to give up to achieve your goals. Understand ownership, and you'll protect your interests, avoid surprises, and make smarter decisions for your business's future. Now, let's look at running and growing your business, building on a solid foundation of ownership and investment knowledge. Beyond finances, daily operations matter. Accounts receivable is money owed to you. Accounts payable is what you owe others. Manage both to keep cash flowing. Overhead includes ongoing costs like rent and admin salaries. Control these to protect profits. Scalability means growing revenue without huge cost increases. Software is scalable. Handmade goods are less so. Investors love scalable businesses for their growth potential. Sometimes you need to pivot, make a big change in strategy if things aren't working. Many successful companies started with a different idea. Before investing heavily, build a minimum viable product, MVP, a simple version to test with real customers. Learn what works before scaling up. Smart operations and adaptability are keys to long-term success. Let's finish with customers and competition. Business is all about customers. Track customer acquisition cost, CAC, what you spend to get each new customer. Lifetime value, LTV, is the total revenue you expect from a customer over time. Your LTV should be much higher than your CAC to be sustainable. Watch churn, the rate customers leave. High churn means you're losing ground. Reducing churn is often cheaper than finding new customers. Know your market share, your slice of total industry sales. Build a competitive advantage, better product, price, or service. Barriers to entry, like patents or strong brands, protect your position. When raising money, expect due diligence. Investors will check your finances and structure. The term sheet outlines investment terms, including vesting and stock options. Master these concepts, and you'll be ready to build a thriving business.